Hi, everyone. I'm Jen Rogers. Thanks so much for joining us. Our guest today is the Global Head of Real Estate Research at Nuveen, Donald Hall. Got some news for you. He says the real estate market correction is nearly complete and that investors need to be taking a fresh look at the asset class. So, Donald, we're going to get to you in just a second, but I want to remind everybody before we start that we want to hear from you. We want to know what your questions are. So please put them in the chat and we will try and get to as many as we can. Also, we have a poll out there, so go and answer that. It's about how likely you are to allocate to real estate. So, Donald, welcome.
Thanks, Jen.
It's been a real slog the past couple of years for real estate. I guess let's look back and look forward. How bad has it been, and why are you hopeful now?
Yep. Well, it's been tough. It's been a tough, really, 2 years of correction. We saw early on, so through 22, real estate continued to do well. Equities took a bath. Fixed income took a bath. As a result, that put everybody well over their real estate allocations, at least on the institutional side. That caused a bunch of folks to run for the exit. So we had big redemption queues across the industry, which were a challenge. We've been dealing with really elevated construction levels. So when construction financing was cheap, a lot got underway. So the last 2 years have been a lot about a reset in fundamentals, particularly for apartment and even industrial as well, just due to the level of supply, plus the impact of elevated interest rates and what that has done to values. So it's been a tough 2 years. But I think, I keep an eye on a lot of different data sources, and there are lots of signals that make me positive to go forward from here.
Okay, so let's get to some of those signals because, this is not going to be a surprise to anyone out there. People keep seeing negative headlines about real estate, right? You'll hear, oh, this office tower sold for 90% of what it was worth just a few years ago. So you get these big headlines, but you're pretty optimistic. So what are the signals? What are the fundamentals that are telling you this has actually changed?
That's right. Well, I'll start off with the U.S. office market, or at least an anecdote that'll provide some differentiation across the market. Late last Thursday night, MSCI Global Quarterly Property Index data came out. You get data across 21 countries. Across all 21 countries, all 21 had positive total returns, right? And you can break that down further by segment. So you're looking at Netherlands retail and Australian residential and US office. Of those 51 combinations, 44 of them had positive total returns. So US office was one of the 7 that didn't. US office was second from the bottom, right? It's been tough and continues to be tough, but that's not the whole market. And not only is that not the whole market, but for the investment vehicles that most people can invest into, your average non-traded REIT doesn't really have much exposure to US office. So from that standpoint, I think US office is a concern for landlords that own US office, but it doesn't need to be a huge concern for folks wondering whether or not they should be getting back into the asset class more broadly.
So when you're looking at the sectors, we do have a question in here, looks like from Daryl. When you're breaking down the sectors, where are you looking for the best mix of reward versus risk? It sounds like office is still maybe not the subsector.
Office,
but I don't want to put words in your mouth. Which ones are you seeing be more?
I'd say it's more nuanced than ever in terms of not just the sectors, but the markets and the micro markets that you're looking at. So let's talk broadly about U.S. apartments. U.S. apartments right now are actually in a pretty healthy spot, or they're getting healthier. We had really about a year where we were dealing with, well too much supply in the sector. As a result, rent growth has been like 0.1, 0.2%. It's actually been a pretty soft market. But that ranges from a market like Charlotte, which had been really hot, but now has -5% rent growth and 15% under construction as a percent of stock, to markets like Chicago, which have traditionally been sleepier, but it has seen some of the strongest rent growth in the country. So by really looking through the data, you've been able to find opportunities in places where you haven't traditionally found them in every property type. But on a big picture level, I'd say broadly, I really like healthcare. And by healthcare, I'll talk about medical office. So office is a bad word, but medical office is completely different. Sometimes you hear it called as medical outpatient buildings, and senior living. So within senior living and medical office, you've had 14 quarters in a row where demand has exceeded supply. So, the new demand has exceeded new supply. As a result, vacancy is at all-time lows for U.S. medical office. And similar to everything else, there's not that much construction underway, and you have huge demographic tailwinds. And the story for senior living is pretty similar. There, when everything else started to see a big construction boom and construction financing was cheap, you saw a lot of folks pulling their parents and such out of nursing homes or out of senior living. As a result, nothing got started. We're not dealing with any supply issues there now. So you have a good runway, I'd say, in both of those sectors.
Just reminding everybody to take the poll. Let us know what you're thinking about in terms of really your time horizon here for getting in. A question from Edward Johnson. So if you're looking at getting back into real estate as an asset class, what kind of product should they be looking at? Is it mutual funds? Is it ETFs? Like where should they be talking to clients about getting in?
I think it's a both. I mean, look, in my role, I'm focused on private real estate. Public real estate has, so public REITs have a stronger correlation to the S&P 500 than they do to private real estate. They act a lot more, like a stock than they do real estate. So in my mind, the answer is both. But traditionally, folks have liked private real estate for that kind of non-correlation to other asset classes.
Got it. I've got an update on the poll. How likely are you to allocate to real estate? Very likely to do so within the next 3 months is almost 30%. Will watch and wait for up to 6 months, leading right now with about 43%. I was invested already, 21%, not considering. It's making up the remainder, but small. So it does seem like people are either making a move in 3 or they're waiting on that 6 to maybe see a little bit more. Can you talk about why right now people, especially after what we've been through, it is important to go through and just rebalance in a sense what's going on in your portfolio with real estate? Why do people need to do that now?
I mean, look, I don't think folks are crazy for waiting, but I think you ought to be considering like time waiting back into the market and starting to dip your toes back into the market. So if you look I think a lot of folks are waiting for values to turn around. And you heard me before talk about total returns, right? So of those 21 countries where you saw all 21 had positive total returns, in Q3, only 11 had positive value adjustments. 10, had moderate write-downs. But they were moderate enough where your income component more than made up for that loss in values, where your experience as an investor, which is, on a total return basis, was positive. So I would encourage folks to start thinking about that you don't necessarily need to wait for. It's hard to time private real estate. It's not a stock where you can go in and out quickly, right? So what you're looking for is cues, and I think those cues are there. Another thing I would throw at you, which I think is a surprise to a lot of people, it was a surprise to me when I did the math. If you look at U.S. real estate, where the data goes all the way back to 1978, your CAGR, your average return since 78 to today, is 7.8%. 90% of it, and that's not a miscalculation, it's a full 90%, has been income returns. Capital appreciation is helpful. In some decades, it makes more of a difference than others. In 2010s, capital appreciation was about 48% of your experience. Income returns were 52%. But income is the name of the game in real estate. So with those sort of strong and consistent income returns, and with values basically at least bouncing here, I don't think there's a big risk at this point to start to weight back into the asset class.
It's really interesting when you turn the lens and you're looking back. I've got this Nuveen real estate report from October of this year that you shared. And I found it fascinating because you looked at total returns after downturn. So you went back and you looked at what happened for total returns in the 5 years after the recession in the early 90s, tech wreck in the early aughts, after a great financial crisis. And tell us what you found.
Well, you've got the report, so tell me if my memory is right.
Yeah.
But if I'm pretty good at this usually. If I remember correctly, after the early '90s recession, for the 5 years thereafter, on a cumulative basis, you had cumulative returns of 76%. I think after the tech wreck, you had 98% cumulative returns, and after the GFC, I want to say it was 86%.
Yeah.
Right.
Yeah. I mean, it just did that. It's up every time. I mean, you did right on the numbers, but I mean, it's impressive.
Cumulative 5-year returns is kind of cheating, right? So, but on a CAGR basis, it's 12 to 14%, right? And so that's not necessarily going to be our experience coming out this time. Could be less, but I don't think that people aren't coming into core private real estate for 12 to 14% returns. They're coming in for high single digits, strong income component, a low correlation to other asset classes. And I think that's what you're getting. And there's the potential for some upside.
I want to talk about some of the other areas where you see upside. So we talked a little bit about healthcare. I'd love to know some of the other places that you think it's worth right now, maybe not, jumping all the way in, but going in at least and kicking the tires on other sectors, either geographically or in terms of, industrial, retail, what else?
U.S. industrial continues to be strong. We've seen a sort of a reset in vacancies over the last 2 years, but we've seen a real fall off in starts. So, which I sort of started to allude to before. Your new starts today for industrial are 20% of what they were at the peak. We haven't seen this few groundbreakings in over 10 years. And so, as you translate that into what's under construction as a percent of stock, you're already at pre-pandemic levels. And as those starts, start to translate into a fall off in deliveries, which they already are, then nothing is really in your way for, as long as you continue to have positive demand, you would then see rising occupancies and rising rents. And that's frankly a story across sectors. Retail is a sneaky one. Collectively, as an industry, we've ignored retail for about a decade. Investors didn't look at it. Nobody wanted to touch it. As a result, we've actually let it heal. It started to reprice sooner than everything else. Nothing's been built in about a decade. The consumer's pretty strong. You actually have your lowest vacancy rates in the retail sector that you ever had. Malls, not so much. Good malls are okay. Average malls challenged, but your neighborhood and community centers, like your local retail, is really healthy today and worth a look.
What do you think the risks are to the thesis? And specifically, we got a question from Brian in here. How would a rise in the long end of the yield curve affect your view of the market?
It doesn't help. It doesn't help. Look, I mean, I think real estate, we'd prefer to have lower interest rates. But I'll suggest this, that the big move was in 22. So the 10-year move, 237 basis points in 22. From 23 through today, it's up 36 basis points, right? So we've had, and I think on a year-over-year basis, it's plus or minus 5. So we've basically been at this level now for a sustained amount of time, and values have reset. They've adjusted to this level. If they went a lot higher, that wouldn't be good. That would be painful. But if they more or less stay where they're at today, what we're seeing on the floating rate debt side, I think has been helpful. There we've seen, floating rate debt has gotten more accretive, and the spreads have come in as well. So I prefer for it to be lower, but we'd be okay with where they're at.
And I guess just a follow up here from Edward Johnson again is, do you wait until interest rates come back down under 6%, 5%? Like, is there a level that you're looking at here?
It's a deal by deal basis. We'd want to do deals where debt is accretive. We generally don't like the idea of leveraging an asset where debt is not accretive, and you sort of convince yourself that you'll grow into it as rents rise. So, overall, that analysis is done on a deal by deal basis. But no, I don't think you need to wait for a broad signal there. The signals I'm looking at are, transaction volumes, it's pricing. I mentioned valuations before. If you look at price indices, so what deals we're actually trading at on the market on a price per square foot basis, you're starting to see an uptick. They're already up 8.3% year over year for industrial. They're slightly below the axis, so slightly negative on a year over year for the other sectors, but starting to be positive on a quarter over quarter. Transaction volume is up marginally. It's marginal. It's up 4% year over year. But I'd argue too that the one thing that you have now as a tailwind, which you haven't yet, are institutional investors coming back to the market. So, I mentioned before how things got all out of whack. We had this denominator effect issue in real estate where everyone was overweight. 73% of global institutions today are now underweight their real estate target. So their corporate boards are telling them, hey, you need to start to, reallocate to real estate. They're looking for the signals that it's safe to do so. And those signals are what I mentioned at the outset of our conversation, which is they're seeing positive total returns in 21 out of 21 countries, and say, okay, we'll start to allocate again.
Fascinating. Thank you so much for walking us around the globe and all the sectors as well. Thank you to everybody in the chat. Those were great questions. It's all the time we have. A big thank you to Donald and also to Nuveen.